Hey there, traders and investors. Todd Gordon of New Age Wealth. Sorry for being a touch late here. Got a few things going on here. Actually, let me try this. Oh, that looks pretty terrible. We got to work on that camera. Anyways, a few things going on here in the tech setup. I'm getting a new monitor. I don't know if you guys have noticed that I'm always like scrunching my old eyes trying to see that monitor in there. So UPS should be here any minute. We hold it in the portfolio, getting a bigger monitor, so that'll be fun. So mess around with technology, and aside from busy markets, it's never dull. So welcome. It's July 21st. And unbelievable move in the markets. Just want to update you what we're seeing there. Let me just check. Audio seems to be working. Looks to be good. So yeah, all's well. Busy couple days. Rebalanced the portfolios. Put some money to work. We'll talk about that. I kind of have the list off there to the side. It's not a great list. But just a quick update, we've been working hard behind the scenes. Ryan's not here. He is moving into his new house in Boston. He's fighting the Boston real estate market, and he ultimately won. So they're moving in, and he's been kind of keeping you guys updated on the blog, which is unreal. Everything that's going on in that real estate market. Up here in Saratoga, it's summer's underway. The track is open. I don't know if you guys have ever heard of upstate New York, Saratoga. There's a lot of Saratogas around, maybe 3 or 4. I know there's one in Florida. I think there's one in Utah, and I think there's maybe in California. I know there's a Calistoga, which is wine country, but Saratoga is the real deal. Track's open, place is busy, it's crazy. I just saw a video. Dave Portnoy just reviewed our friend's pizza place, Gennaro's. Only gave it a 7.1. The other thing I wonder is he still trading stocks? I don't know. He got a whole bunch of kind of young, day trading types in when the meme stock thing was going, and I haven't logged in. I wonder if he's still going or if that sell-off shook him out. And that's kind of normal, I think. I just think back and everyone's saying, "Oh, this has never been seen before," and Portnoy is sort of the figurehead of that meme stock movement, and I was like, it's not new. I'm only 43, but I was day trading in 1998 on an AOL dial-up modem, like unbelievably slow. I was day trading tech stocks back then. You realize that's a dumb game, and I lost all my caddying money. And then, that's when that's when I fell in love with the market. So it's the same story. Anyways, Summer in Saratoga. If you haven't been 3 hours north of New York City, come check it out. All right, so I think we're good there. Let's kind of get into the swing here. As I said, I've been hard at work putting some capital to work in this market. We pulled back, really bearish sentiment. Pretty terrible data, and sellers exhausted themselves, and we're seeing a nice rally up. And again, if I look off to the side here, I'm looking up at this monitor right there, and I'll bring that over back and forth there. Okay, I know it's a little dark in here too. That's all right. So let's roll, guys. Thanks for joining us. And again, I need to up the frequency of these communications. It's too few and far between. But I got to tell you, we've been doing a lot of behind the scenes. Just a lot that goes into running the wealth management business. That's what we've recently done. At the end of 21, launched an RIA. As you guys know, we have clients watching, and we have prospective clients watching, and people will never be clients, but welcome. Everyone can pull up a seat here at New Age Wealth. But I intended to do more marketing, but there's a lot more that goes on behind the scenes than just being a figurehead of an RIA when you're running it, kind of bootstrapping it. So it's all good. So let me pull over the talking points for today, and let's do that. Okay. And this should fade right in there. All right. So, again, I'm looking at a little 12-inch monitor there. Pretty soon, UPS, which we hold in the dividend portfolio, is going to bring me a nice 15-inch. So we'll be smooth. We'll be smooth for next week. So it's July 22nd. Markets are ripping. Let's just give it a little. Let's give the market a little check here before we jump in. We have a pretty unreal rally going on. Nasdaq continues to go. We've had 3 days of unreal gains, probably in the order of 8% from the lows. Nasdaq's up 1.1. Dow is flat. That's really interesting. RUT is actually down. Small caps have been leading it. S&P up 0.5. Bitcoin's off a little bit. I know Alex, who runs our crypto side at Trading Analysis, which is my other company, they're long Bitcoin, and he tried a couple times to scoop that from the lows, which is good. There's a lot of correlation between Bitcoin and risk on growth stocks, and specifically tech and semis. So no surprise that we're seeing pretty good support from 20,000 in Bitcoin as semis and the Nasdaq are leading the way higher. We'll talk about that here. Just looking at other markets here. Crude well below 100 at 96. Copper's off just a touch. VIX 25. Doesn't care if the market's selling off 30%, really doesn't want to get above 35, doesn't want to get below 20. VIX just might be kind of useless in here. Bonds are catching a little bit of a bid, which I think is a good thing. Bonds up, stocks up, and specifically bonds up, Nasdaq up. That's interesting. So remember, bonds have been going up in sort of a flight to safety. Maybe not as an aggressive Fed as we would as we've been led to believe. We'll talk about that. Dollar's been a big one. Dollar just absolutely huge breakout here, and there's a lot of debate. What does that dollar strength mean? I mean, this is a range that goes back to 2014. That peak was 2016, failed in 20, and the U.S. dollar broke out. And of course, what we're looking at here is the dollar against a basket of 6 currencies that goes into this dollar index. My friends on CNBC affectionately call it the Dixie, DXY. So dollar breaking out. Some people take that as a risk aversion. I take it's the other way, that it's the rest of the world selling their stocks to buy our stocks, selling their local currency to buy the U.S. dollar to buy U.S. stocks. So I take it as a good thing. Commodities are off. We're going to go into that. I'm going to take you through this whole list of commodities which have come off quite a bit and help the Fed's position, and that's actually caused us to make the moves in the portfolios that we've done. I'm going to show you the real portfolios that we're running here for clients. Tesla up 10.10%. Big, huge move after earnings. Crazy move in Tesla. Unreal. Everything that's going on with Elon, the pictures of him being fat in Greece next to Bezos, who's jacked. I don't know. Personally, I'd rather have a fat CEO who never leaves the office than a guy who's in the gym every day. I don't know. It's up to you. That's your decision. So there's a lot to talk about. It's just a quick run through of the markets here. So just quick disclaimer: we are an RIA located in Saratoga Springs, New York. Just take a quick look here. Past performance is not indicative of future expected performance. This isn't a solicitation to buy or sell. This is strictly the way that I view the markets, and not saying that you should go do this in any sense. Have a professional manage that for you. If you guys don't know me, real quick, I know I've been real quiet on social over the last 2 years of setting this up, and I've stepped away from trading analysis. Work closely with those guys. That's my trading and advisory business that I started in 2012. And started on this path, wealth management, and so there's probably some people who have no idea who I am. So here's just a quick rundown of me. I've been doing CNBC since 2010. Probably been on 300, 400, 500 times, I would say. Founded tradinganalysis.com. That's my trading and advisory business. This is my wealth management business. Traded for a foreign exchange hedge fund. I was a senior trader for Gain Capital Asset Management, and that's how I kind of broke away from corporate life during the 2008 and 9 global financial crisis. Got a pretty big following on Twitter for trading live, and broke away, started my own business. Prop traded right after college, St. Lawrence, University of Albany. I was a Division I ski racer with a minor in stock trading out of my dorm, with a second minor in college activities, and a third minor was academics. Okay. So let's talk about the Fed to start. Everything's about where we're going to be, where the Fed's going to raise the federal funds rate. So you have interest rates across what they call duration or maturities across the yield curve, and they serve different purposes, right? So the shorter term rates, like the 2-year and less, that equates to the yield that short-term U.S. Treasuries pay. So 2 years and below, short-term 2-year Treasuries. There's even, there's 1 year, there's 6 months, there's 3 months. The Fed, when they move interest rates up and down, every meeting, that's going to impact those shorter duration maturities. Okay, and where the Fed sets interest rates, they're trying to either slow or they're trying to slow borrowing, slow the growth of the economy to perhaps cool inflation, which when an economy becomes overheated or there's too much money floating around, too much investment, too cheap to borrow money, causing that investment, that's when inflation happens, and that's what's happening now. Or on the other side, we have supply shortages, which it's a demand issue, but it's also a supply issue. If there's a limited supply, prices get bid up, and the Fed needs to try to control those escalating prices by moving the short end of the curve. So what we're looking at here, again, is where the Fed's going to set short-term rates. And that's where you hear about the Fed moving rates, this meeting, they're going to go 25 basis points, 50, 75, 100, whatever. That's what they're talking about. And 25 basis points equates to 0.25% at that short-term rate. So currently the Fed funds is at 1.5 to 1.75. That's where short-term money is right now. We're looking at July 27th, so we have less than a week to the next Fed meeting. And these Fed fund futures are always moving back and forth based on reacting to what's happening in the markets, data, geopolitical events, whatever it may be. Markets are trying to guess where the Fed's going to put rates. So right now, I'm just looking up to the side here because, again, my small little monitor up there doesn't allow me to see as good as I can here. So right now, we're looking at 150 to 175, going up to 2.25, 2.5. So we have currently a 70% chance. Market expects 70% chance that we're going to go 0.75%, 75 basis points. There was talk after that really bad 9.1% CPI that was 2 weeks ago, I think it was the 13th or 14th, of going 100%, full 1%. That hung around for a couple days and then it sort of backed away. So that corresponds to right here. We got up to a 44% chance of going 1, and then it went down 31 and 29. So that's backing away. So it looks like we're going to go 75 basis points. Okay, so tack 75 basis points on top of 1.5. Now our new lower target is 2.25, and there's a long gap between July, Fed, Congress, everyone gets August off except people who actually have to work for a living. And then the next meeting is September 21. So now we have to think that the new base rate is 2.25. So where the market's pricing again, 2.25 to 2.75. That's a 50 basis points, 38%. Another 75 basis points. Right now we're at 50%, and then they're still giving a 14% chance of a 100 basis point increase. Consider or with the expectation that next week they're going to go 75 basis points. So you just look at any of the movements in the Fed funds. There's not been too much. Everything looks pretty steady out to that September meeting. But the point that I want to drive home here, and I'm going to try to pull this together here, July, real quick. July, we're going to go from 1.25 to 1.5 to 2.25. September, we're going to go up to about 3. Okay. And then we go up to November, and now you're looking at 3.25, 3.5. So you're looking at about 44, 66% chance of 3.25 to 3.5. Then as you get out to December, you start to see the elevation in terms of probabilities gravitate around the 3.25, 3.5, maybe 3.75. Okay, so if I were to keep going, the Fed, this program doesn't go out much further than that. The point that I'm making there is, guys, the natural rate is going to go. The terminal rate of the Fed fund futures is according to the markets right now, about 3.5 to 3.75. The market knows that. And the stock market is forward-looking enough that it's already discounted that in. Okay, so it almost doesn't matter if we go 50 now, 75, and then 100 in the next 3 meetings, or if we go 100, 75, 50, or if we just go all 75s. We've all pretty much wrapped our head around the fact that we're going up to 3.5, 3.75. Right? Inflation right now is year-over-year running 9%. There's a lot of evidence to suggest as housing has come off, as commodities have come off, there are still some elevated components of CPI, car prices, rentals. It's going to take a while for these interest rate increases to filter through the economy to bring prices down, which takes the stress off the Fed to cool inflation. But it will take some time to filter through the economy. But we're going to 3.5 right now, okay? And if inflation moderates at 6%, let's say, or 5%, it seems to be that the market is content with that. We need to back away from 9, 8. I don't even think the market would be happy if in 6 months from now we fell to 7, and we'll take a look at the tips. In fact, let's do that now. Let's jump ahead and look at where inflation, the markets are discounting inflation to go. And I like to do that through the tips, which is the Treasury Inflation Protected Securities. I don't know why that's playing. So let me just pull that up. Fundamental chart, and then okay, so let's go over here. Let's go 5-year tips right here. So this is the 5-year expectations of inflation. Okay, so you could see we got up to as high as 3.59% at the extreme in March of 22. 5-year expectations was 3.5%. We've backed down to 2.67%. And if we just go in here, let's go year to date on this. So this is where inflation is expected to be. And you can see we've come off quite sharply on this. So inflation is expected to moderate, okay? We still have, housing is the biggest component of CPI. We still have a housing shortage. Building permits are off. It's hard to get workers in. It's hard for builders to plan 6, 9, 12 months in the future, budget costs, budget labor. It's hard to incentivize those guys to go out and do that with such an uncertain future right now. So we need more housing supply. The demand is there. Mortgage rates have moved up in reaction to obviously everything that's going on here with rates, but those also have come off. I think we're at about a 5.5% national average on the 30-year. So I think housing, which is the biggest component of CPI, will also moderate. If we go out even further, you can look at the 10-year tips. 10-year tips break even. It's going to be the same situation here. We got up to we only got to 3.02% in April 22, and since that 3% reading, we've backed off to 2.37. So you're off pretty good there, 65 basis points in terms of future expected inflation. So the point is, I don't think this is here forever. I think people realize it's more transitory than Jay Powell expected, but it's going to take time to retool the supply chains like semis. It's going to take more time to build houses. And again, what happened is during COVID, everyone shut down production and didn't realize the Fed was going to shower and the government was going to shower the economy with fiscal and monetary stimulus, and that actually increased demand, and people who retooled down said, we went the wrong way. It's going to take a while to undo that following the global pandemic. So that's that. Okay, so that's just looking at the Fed. Let's keep going here. There's been a pretty good reaction in the asset classes, and I don't really have a good way of explaining what these ETFs are, but there's been a good rotation out of value, okay? as interest rates have gone up, as inflation's gone up, the temptation for investors to own stocks that have a high valuation, no current yield, no dividend, and the promise of profits 2, 3, 4 years down the line, that becomes a hard argument to make. So when interest rates go up, you start putting in the discounted cash flow analysis. You look at the current value versus the future value of your income streams. You look at companies that are more reasonably valued, more old economy stocks, what we call value stocks, and those have rotated in pretty considerably as we've seen this inflationary spike and move up in rates, as I just described. So as a portfolio manager, which I am, we had to be favoring value stocks in a time that value was outperforming growth. Now, as we're starting to realize that inflation isn't going to be here forever, the Fed is not going to have to hike to 5, 6, 7% Fed funds. We're looking at 3.5% terminal rate. Earnings, we're only about 9% or so into earnings season. And so far, the earnings are not anywhere near as bad as they told us, and it's the collective they told us they were going to be. And also the forward revisions and the warnings and CEOs saying look out for Q3 haven't been as bad as they told us it was going to be. So we're seeing a pretty sharp rally in the stock market, but we're also seeing a rally back into growth. And that's the point that I'm trying to make here. So I know this is a dark chart here, but what we're looking at is a quantitative model I look at called relative rotation, and it measures the different market capitalizations as well as the kind of stock it is. And I don't know a good way to name it. I'm calling it a style. It's for lack of a better word. Value versus growth. You talk about, let's call it all economy, new economy stocks versus various market capitalizations, small, medium, and large. And what we're doing is basically watching this. I took a static image of this just for resources point of view on the computer. Basically, it rotates in a clockwise basis around the intersection of the XY axis, which is in this case the S&P 500 benchmark. And as the markets are rotating up here in the top right, this is the leading indicator, which is showing relative strength and momentum to that center benchmark. And my goal as a portfolio manager is always to gauge myself off the benchmark. I want to try to outperform the benchmark. That's my goal every single day, week, month, and quarter, and year. So you want to be watching the rotation of growth and value, and also the different market capitalization, small, medium, and large, within that value and growth to dictate where you should be overweight and underweight in your portfolio in hopes of getting that overweight or under or over performance relative to the benchmark. And these lines here originated in May, which was our last rebalance. So we just rebalanced. We went about 2 months before we rebalanced, and what you can see is the arrows that are pointing to the top right are picking up momentum and relative strength compared to the broader averages. And those specifically are the S&P 500 growth, mid-cap growth, and small cap growth. This iShares Russell 2000 is small cap growth. These guys in May, June, and now into July have taken a big right-hand turn to the upper right quadrants. Indicates we're gaining relative strength on the market, and at the same time, the small cap Russell 2000, which is just your IWM ETF, your Russell 2000, which is not broken up into value or growth, but the top 200 value right there, value stocks, as well as the 500 value. There's mid-cap value. They're all rotating from that upper right outperforming quadrant down into weakening. And then I think it's going to continue into June, July, and August, get down in here into the lagging quadrant, as I think growth is going to continue to go up. So we reorganized the portfolios based on that assumption that we know terminal rate of Fed funds. We've seen commodities come off. We understand housing supply needs to increase. We understand the demand is there. We'll see when consumer discretionary earnings come out. The consumer seems to be okay. We are seeing price at the pump moderate a little bit. Haven't really seen the housing prices come off yet, but they should be coming, and I think that's going to continue to allow the rotation in. We have a big CHIPS bill coming out right now. I had a preliminary successful vote at the Senate. I think it goes to the House next week. It's a $52 billion semiconductor bill to keep us competitive with China. I have the semis lined up in here, and I'm pretty sure that's going to pass because I think it's getting bipartisan support. So let me just take a breath here. I don't even have the YouTube window up. Let me just see if there's any comments or questions in there. I'm just rattling. Semiconductor bill to keep us competitive with China. I have the same. Okay. Let me know if you guys are in there right now. Just type hello. And again, this channel's been so quiet for 2 years. I know we used to get a ton of people coming in, thousands of people coming in. I left this dormant for a long time, so I gotta CPR this YouTube channel. Type in there, say hey, what's up? Tell me what you're doing. Tell me what you're doing this weekend. Tell me where you're calling in or logged in from, or tell me if there's any issues. Okay, so back to this. Is you get down into the sector level, right? So the way this works is you have the major stock indexes. You have the S&P 500, which is sort of the granddaddy index, and then you have the Nasdaq 100, the Nasdaq Composite. I love the Nasdaq 100. Below that, the Dow Jones Industrial Average, top 30 stocks, kind of arbitrarily picked. It's sort of an antiquated index. Then you have the Russell. So those are the major indexes, and then below that, below the S&P 500, you have the sector level, 10 major sectors that make up the American economy. Let's see if I can do it. Technology, discretionary, communications, industrials, materials, utilities, healthcare. Did I say utilities? I'm repeating myself. Healthcare, energy, that might be 10. Real estate is another one. YM, miss you too. Modern Picasso, what's up? Never lurking. Hello, hello, what's up? So these are the major sectors. And again, this gives you more of an insight into how the rotation is happening. And listen, the rotation based on those 10 sectors that make up the American economy are moving in anticipation of what the related fundamental data and earnings reports will be in each of these 10 major sectors. This always moves ahead of the underlying data. It's just the way it works, okay? We're starting to see a tech breakout. People are just now starting to talk about it. Dude, it started moving. Growth, mid-cap, small-cap growth started moving into the improving quadrant from the basement up into basement dungeon, up into the improving quadrant back here in May and early June. It's now July 21, and I'll tell you what, it's just now becoming mainstream. So if you look at some of the sectors that are taking the same track, what's going in a counterclockwise pattern? What's at like 7, 8, 9, 10 o'clock heading up till noon and 1 o'clock in that direction? So you've got consumer discretionary in green, technology in teal, communications in blue. There you go. Okay, and even real estate's kind of making a hook to the upside. Financials have been kind of lost. I haven't been very interested in financials down here. And then what's rotating out? Okay, what's rotating out? You have healthcare, which is sort of a defensive play, is coming down. That means it's losing momentum. You have, that's utilities, consumer staples, and materials. Those are mostly defensive sectors. Materials is going to be more inflation sensitive, and the reason the market got defensive is because we have 42-year high in inflation. So what's happening? You're seeing a rotation. You saw a rotation in June into the more offensive sectors like consumer discretionary, communications, and tech, and out of the defensive ones like utilities, healthcare, staples, and the inflation-sensitive materials. So this has been happening for a while. Okay, so we made some portfolio, incredible moves in Apple, YM, incredible. So we made some moves just now in the portfolio. So let me show you what we're doing there. Okay, so we run two main portfolios here at New Age Wealth. Tactical Dividend, which is a portfolio of roughly 40 to 50 individual stocks. Each must pay a dividend. Each must go through a fundamental screen in terms of valuation, forward valuation, margins, revenue growth. There's a whole formula that goes into it. It's got to go through certain scans, but they have to pay a dividend. The other portfolio is slightly less constrained. It is less constrained. This is the alpha growth, which basically looking for the stocks and sectors that are outpacing and leading whatever stage of the business cycle we're in, or whatever rotation it's happening, or whatever theme is driving the underlying markets. We're looking for the stocks that are on the leading edge of that, providing us the most alpha, which is outperformance. So real quick, today's presentation here, I'm just going to be focusing on alpha, tactical dividend, some of the highlights of what we just did. We reduced cash holding from 5% to 1.5%. So we put cash to work. We increased tech allocations in tech, consumer discretionary, and communications. And no surprise, we reduced allocation, energy, and financials. Okay, so you can see the adjustments that we actually made there. So we increased tech holding by 4.5%. We're at 28%, which gives us a 4% overweight compared to the S&P benchmark. So we increased tech, consumer discretionary, communications. We dropped financials. We dropped energy. We halved energy. Okay, and that's a big thing that we've done. When we launched in October, I was heavily overweight energy because that was the sectors responding most to the inflationary pressures as well as the geopolitical situation in Ukraine. So that's where you needed to be. And we have and I've been warning my clients that we were going to pull that back, and we just cut it by 4.5% in the dividend and cut cash by 3.5%. So New Age Alpha, we had a high cash position from May into end of May, so early June into July. We were at about a 10.5% cash position, plus I had an inverse ETF. I actually had a short hedge. I was holding PSQ, which is the QQQ inverse ETF, as a bit of a hedge. So 10.5% cash, 4.25% allocation, or 4.5% allocation at PSQ. So we had, let's call it 14.5% cash, but it was actually more like 20% because we had that inverse ETF hedging. Right, so we went for pretty good defensive position. 20% of the portfolio was hedged. Took that off the short hedge PSQ in June, and we just deployed that cash. We increased holdings in technology. We upped by 9.25. So we're still underweight the benchmark for alpha growth, which is the Nasdaq. We use the Nasdaq to benchmark against this. So Nasdaq has 51% weighting in tech, so we're still a little underweight, but we increased by 10%. Increased consumer discretionary. I think the consumer is going to be okay. Increased communications. There's a lot to be said there. Netflix, big move in Netflix after earnings. Meta just squeezed pretty hard. Everyone was counting that for dead. We held Meta in the portfolio. We actually added to it. I'll show you. And then we decreased energy by 5%, so we're at 7.25. We were at 12 in the last rebalance. We cut that by 5%, and we went from 14.5, which is more like 20% with that short ETF, 20% cash, and we're now at 8% cash in the alpha growth. So still some dry powder. Do I think the low is in? I do. I do think the low is in, but I'm also smart enough to know I'm not smart enough to call the end of 30% market moves. I'm only 43, but I've been trading since I was 18, and that's all I've ever done. You do it that long, and I guess you just get humbled enough to say, nobody knows for certain what's going to happen. You're always second guessing yourselves, and I was tweeting about that. I was saying, marketers and people are trying to grab your attention, talk uncertainties. It's going to happen, and the crash is coming, and blah blah blah, and this bullshit. Excuse my language. It's so stupid. I always talk in probabilities. I think in probabilities. I'm always second guessing myself. I never come out, and it costs me headlines. It costs me views and clicks and likes and all that crap. But I'm a trader first and foremost. Now I run a wealth management business, so I'm even more so thinking in probabilities and looking at both sides, and that's just the way you have to be if you're going to run money. Otherwise, you're going to get crushed, and you're just a talking head marketer. So I have 8% cash in the growth. If we do roll back over, I'll put it to work, and I'll hedge us on the downside. I will. We'll make moves, but if we do continue higher. And earnings, as we move, we'll take a look at earnings season. If we do continue higher, I'm going to put that 8% to work. I don't know. I think it's the most important thing for for a trader or investor who's running money to say I don't know, and I don't know. If you don't say it, you get humbled. Okay. Yeah, I agree with that. Anything's possible, but leaning bullish. Yeah, anything's possible. I mean, God, I mean, Putin could drop a bomb tomorrow, and then what happens? I mean, Biden got COVID just now. Market sold off, and then it rallied. Anything can happen. Okay, so let's keep going. All right, so this is how we're doing. And again, this is calculated. This is performance of the alpha portfolio. It's benchmarked to the Nasdaq. We're trying to hold growth stocks. This is life to date, and this is net of the 1% fee. So we got, what is it, 7% outperformance, give or take. And one thing I would note here is the alpha portfolios in purple. We're not performing as well from the lows because, again, we had a good amount of cash. So we haven't participated in the rebound as much as the market has. So the NASDAQ is starting to close the gap a little bit. But we just, again, we're only 8% cash. I'll show you the names that we increased exposure to. So if we do continue, I expect that separation to continue. So here's some of the specifics as I talked about in the growth portfolio. I'll talk about a few names that we increased. Maybe this helps you. As I said, reduced cash, 14.38%, closed the PSQ hedge, increased tech, consumer discretionary communications, cut financials, reduced energy financials and industrials. A couple key names, as I mentioned, Meta. I'm not giving up on this. I know it's hated. I know a lot of people don't like the way Zuckerberg ran the company, but it's turned into a value stock. The valuation is compelling. I like what they're doing, and the AR and the Meta. Hold on, I'm a dork. I don't care. It's called field research. I'm telling you, these things are cool, and I check in every now and then. That's Meta's Oculus Quest 2, and I fired it up for the first time in a month or so just to see what they're doing, and they're making pretty good strides in there. I'm very bullish on it. I mean, I reduced the holding in Meta. I went down to like 1%, and I said I'm willing to cut it, but the valuation on this is so compelling. I think we might not be as far away as we think in terms of virtual reality becoming our reality. I follow some of their high up sort of evangelists or high up guys on LinkedIn, and I kind of stalk them on Facebook, and they put some pretty good content out there. So let me just show you Meta. And I tell you what, I'm actually pretty encouraged. I don't think we're as far away, and the market is responding. Plus, there's some interesting stuff going on with TikTok. I mean, they made a statement that they're trying to sort of divest from the U.S. and focus more on Asian markets. And Facebook got a bid, Meta got a bid on that because TikTok's biggest, I think, competition is Instagram and their Reels. And I know YouTube is doing Reels as well. I know my trade analysis team is working on Reels and marketing and stuff. So Facebook got a little bit of a bid on that, and their spend on virtual reality, their last earnings was expected to be $10 billion, and I think it came in a little less than that. So we'll see where it is now. But if you look at some of the stats on this, I mean, we're trading 15 times forward earnings. Like the S&P's 21 forward earnings. Current P of 17. The S&P probably 18 now. Facebook price to earnings ratio is 13.78. You have 5%, 5-year growth, revenue growth 33%. Okay, 1.4 beta, which is actually pretty strong. Price to book at 4, price to sales at 4.3. So I mean, you're talking about stocks trading 15 times forward earnings. If we look at the estimates on Meta, estimated for 22 is $11.50. Just bring a calculator here. So if you do 182.17 divided by 51 for 22, 15.8 times earnings for 22. Sometimes it gives us 23 estimates, but it doesn't. Oh yeah, it does right there. 13.41. So for 23, it's trading 13.53? No, 41. So for 23, it's trading 13 and a half times earnings. I mean, I just think that's really, really compelling. And then you look at the balance sheet. There's a ton of cash on this, and I'll tell you when earnings are coming up quarterly. So we've got $7 billion in the balance sheet, 14, call it 15 in cash and cash equivalents, 30 billion short-term investments, and they got $44 billion on the balance sheet. 11.5 of receivables. Total current assets of $60 billion. Total assets $164 billion, and then you just look at total liabilities. So 19, 21 in current liabilities. What did I say? 164 billion assets and 40 billion in total liabilities for shareholder equity of 110 billion. I don't know why that's not. Ooh. I mean, they got a lot of money to spend. I just hope they can do it. I hope they can do it well. Okay, so that's that. All right, so Google, increased Google, that's fine. We'll talk about that one later. Amazon, I think we went up from 2 to 3%. I think Amazon made their mistakes with with their distribution services. They were underperforming the market for a good year and a half, almost 2 years. I could pull that over quickly. And if you just take a look at like Amazon against the S&P, I've been underweight Amazon for a long time. I think this chart is pretty compelling. Let me see if I can just bring this over. They made their mistakes, and I think they're fixing them. Come on, clone chart. This will take just 1 second. Come on. I get it. This software is just too it's hard to use for real-time productions. So this is Amazon relative to the S&P. So you can see that the stock has been ripping on the upside, but relative to the S&P, this is Amazon divided in the S&P. As this market is moving higher, as this price chart is moving higher, Amazon is outperforming the S&P. All of a sudden, in like October of 20, we started losing relative strength. Amazon was underperforming the markets. You're talking almost 2 years, a year and a half of underperformance in Amazon. There's no reason to be market weight Amazon when it's underperforming the market. It's issues that were just recently discovered were already at work, and the market was starting to sell that off. And they had that the last or two earnings reports where they had a big write-down with their EV investment. They had some mismanagement of their distribution and warehouses. I mean, that I think has been addressed, and we're actually starting to see Amazon come back. So I did want to increase my exposure there in Amazon here and start to play the recovery. Just push that out of the way. Okay, so that's that. Tesla. Biggest holding there, crazy earnings report. We'll talk about that one. So we went from 6.5 to 7%. Added back Lulu. That's a play on the consumer. I do think Lulu continues to be a good business model. That stock sold off quite heavily. We cut it. We got back into Lululemon. I like it. Apple. I kicked up Apple exposure big time from 11% to 14.25. So we're pretty overweight. Apple, let me just show you. I believe Apple is what percent is Apple of the Nasdaq? Apple is 13 now. Interesting. So Apple is 13% of the Nasdaq, Microsoft's 10, Amazon is 6, and then I think it's 7% of the S&P 500, SPX. Constituents. 7%. Yep. So we kicked Apple. So I'm actually double the S&P in Apple. I love where they're at. I think 5G upgrade cycle is going extremely well. I think they've got some good projects coming up. That valuation has come back quite well. I think it's and we're starting to see pretty good outperformance there. Microsoft, I did not like it. I went from 4 to 6. We're seeing a big move in NVIDIA. I added Qualcomm and I added Palo Alto Networks. So those are new names in the technology space. And here's the semis. Speaking of NVIDIA, so I went from 4 to 6. So I increased my holdings by 50% in NVIDIA. And this is the ETF that tracks semis, SMH. And it might be just this simple. Okay, so you guys know I'm fundamental and I'm technical. I'll use whatever and everything available to me to help make the best decision, allocate the portfolios. And it could be as simple as this orange line. That's it. This is the 200-week moving average. So you take the closing price on Friday of the last 200 weeks, you average it up, and you plot it every week. You take the the last 200 look backs, you plot it, you plot it, you plot it, and this 200-week moving average has held it since 2015, 16, 17, COVID, and we just tested it again. Moving averages are pretty subjective. You use the 50, the 21, the 100, the 4,000. I don't know. You use the one it works. So pretty interesting that this is held again. Same kind of concept here. This is the SMH relative to the benchmark S&P. SMH has been outperforming. Topped out here mid-20 and sort of put in a double top. Sold off here a little bit. But I think as we get off of this weekly chart, each one of these little white bars is 1 week of trading. And then we break it down to the daily. Each one of these is now 1 day of trading. This is the SMH relative to the S&P. Look, end of June, end of July, we're making a sharp spike higher. We're starting to see outperformance of the semis relative to the broader market. We've got a little downtrend resistance here. We've broken resistance at about 228. And you're seeing names like NVIDIA lead the way. So we broke resistance. We're seeing outperformance of the semis. Plus, we have that chips bill coming up. It's $52 billion that's going to be allocated, according to the Commerce Secretary, on a application basis, those most in need. And one of the qualifiers is semis, and the production has to occur in the U.S. No overseas production. So that's interesting. There was a pretty good interview on CNBC with the I think it was the Commerce Secretary. I think that's right. But yeah, I think it's time to get back into the semis. They are leading technology up. Okay, let's take a breather here. I'm sure I've been going for a long time. Too late to get in on semis? No, I don't think so. Too late to get in semis. Let me just go back. I mean, look, here. Let me pull up a chart here. And this is going to get a little gory in terms of technical detail. I'm not gonna talk about it. You're going to see some stuff that might scare you. That's okay. No. So this is a weekly chart. I mean, this is, you guys know I like to follow this wave model, kind of rooted in Charles Dow's Dow theory. If this is accurate, I mean, this is just a simple, easy, to be expected pullback from 325 down into 206. These green bubbles were these fib ratios that we look at. I mean, that's where we expect price to hold, and it held. So it depends on your time frame. For me, am I going to hold NVIDIA until I'm 65? Probably. But the systems traders, the technical guys, they're going to say a breakout's going to occur 243, and then I fully expect this to make new highs in coming years, in the next 2 years. Fully expect it. Okay, so it depends on your time frame. Are you a trader or you an investor? All right, so that's that. Let's take a look. Nasdaq's up 1.1, which is solid. Same kind of situation here in the Nasdaq. A few different wave counts. I let the team of trading analysis do that. I used to do a lot of Elliott wave. I'm sort of going quiet with it and relying on the team at trading analysis to do it. But we've rallied up nicely from 2020. The rally peak to trough 2020 COVID lows up to the highs was 147%. We rallied 147% from the lows, and we pulled back 34%. We rallied 147% from the COVID lows and pulled back 34%. It's kind of the old 3 steps forward, 2 steps back, except this time it's like 3 steps forward, 1 step back. I know it sucks. I hated sitting through it. Lost some sleep, gonna be honest with you, but that's how markets trade. That's how markets trade. So that's the Nasdaq. Getting down to the weekly chart. Let me get down to a daily, 1 bars, 1 day, just see what we can see. Get rid of all the craziness. You know, and look, this is the Nasdaq. You know, pretty much we're at the same price we were in May. We went down, up, 1 more push down in June, messed around June, July. Now we're making a move up. We're not even through the June highs yet. So, you know, are the lows in? I think so. I don't know though. You know, I'm not going to be able to declare all clear until we break up through this sort of trend right here. Get a little bit more clarity on the Fed. Is 3.5, 3.75 terminal rate, and will commodities stay down? You know, I don't know. But we're literally positioning for the future, so you can never accurately predict the future. Here is the S&P. You know, again, we've cleared downtrend resistance. The resistance was about 39.11. We're trading 39.81. There's a few, you know, again, gory technical details I could throw on you, but, you know, again, what you want to focus on is this old high, 41.90 in the S&P area. Oh, that's actually interesting. Check this out. I'm going to geek out on you for a minute, okay? So this rally right here, I can't let my old ways go so easily. This rally right here was 9.38%. The rally right now is 9.52%. A lot of times those symmetrical percent moves, that's what this is right here. A lot of times those symmetrical moves can be very telling. If you break up through 9.5% rally, which again, this was 9.3, this is 9.5. If you break up and we continue higher through tomorrow, and we break symmetry, that's usually a good sign. It's usually a good sign. But, you know, look, I mean, we're low. You know, we're still significantly off the highs. So, you know, look. Think about it in terms of probabilities, as I said earlier. Like, is this the low? I don't know. Nobody knows. Maybe the future isn't even written yet. But if you're somebody, and there's so many clients who have come into New Age and they've got a bunch of money and like, oh, I don't know, I missed it, and you know, how do I get in, and what if this is not the low? Think about it in terms of risk reward, right? If you, let's say you have a bunch of cash and you've been scared to be in the market, you don't know if it's the low, you listen to the news, it drives you insane. Okay, so let's say you buy now, and you know, let's say you're not in it to be a long-term investor and you're willing to stomach another 25% drawdown. You have 8.5% risk from here. If you're right, we should be able to go up and retest the highs. So you have 8.5% risk to the lows. If you wanted to put some kind of protective stop on it, which if you're an investor, long-term money, I don't recommend you do, but if I've seen many people insist on doing it, you're risking 8.5% to make 20%. From here to the old highs. And if we go to the old highs, we're probably going higher. So you're risking 8 to make 20. You know, that's a good bet. Okay. All right, and then another thing I want to take a look at is the Russell. Let me see if I can pull this over again. Optim is pretty slow. This is a lot longer than I expected to go, but I missed you guys. Oh, come on. So take a look at the small cap Russell. So these are the 2,000 stocks that represent small caps. So this is just too slow to use. We're going to look at the Russell relative. Actually, we're not even starting to outperform. That's interesting. I was looking for that relative performance to turn up, and it hasn't yet. We're seeing some pretty good strength in the small cap Russell, but nothing yet to suggest that we need to have any kind of overweight nature of small caps. Okay. All right. Let me do this. Now I want to just flip you through some commodities. So we looked at the stock indexes. Commodities are a big, obviously a big thing here. So let me scrunch up monthly, weekly, and let me just focus on let's do daily and weekly. So, okay, so this is the Bloomberg Commodities Index. June 8th was the high. Look how far the Commodities Index, these are commodities futures, have come off. And again, this plays right into the inflation picture, which besides supply chain, it's elevated commodity pressure, supply chain constraints, and elevated commodity prices that are pressuring the Fed to raise that rate. So this is live cattle. Cattle actually rallied back there a little bit. I don't think meats are so much of a problem. Here's lean hogs. Here's feeder cattle. But then you get some of the soft inputs. Cotton, crushed. Coffee sold off. Wheat, crushed. Corn, crushed. Wow, corn's making new lows. Cocoa, crushed. Soybeans, crushed. Sugar, sold off. Gold, really, I was short gold for a while and took it off. Crude, well below 100, 96. Nat gas, nat gas is coming back, and I got an update on the Russian situation with nat gas. There's a lot, obviously very geopolitically charged, but I'd be surprised to see nat gas go beyond the old 9.5 high. Lumber has come off quite sharply as well. Here's silver, crushed. Gasoline, RBOB gasoline, coming off pretty significantly. So we've seen commodities really take a big turn, and that again is helping the Fed's situation. The dollar rallying also acts as a tightener of monetary policy. It reduces the amount of inflation we import into the U.S., which again takes some of the pressure off the Fed. Okay, finally, let's take a look at Tesla, and we'll wrap it up there. Pretty unreal. I was listening to the earnings call today after I was last night. The earnings call was pretty interesting. People didn't know if Elon was going to be on. He got right on. He talked about obviously supply chain issues being a major concern in prior quarters. The Chinese lockdown with COVID-0 in the Shanghai factory was a major concern. That impacted margins. Margins weren't as bad as they expected, I think. And they also talked about their Bitcoin holdings. So they had a ton of Bitcoin. From what I gather, they bought it around 30,000. And they sold it, I think, a little bit lower. I don't think they made money on it, but it increased the available cash on the balance sheet. And Elon went on to say, it's not a statement on Bitcoin. It's just we wanted to have cash available because of the Chinese shutdown. So, they're bringing on new factories with Berlin and Austin. So that's impacting their operating margin. So he said it's going to be temporary, but all in all, the report was good, and they're starting to hit their records in terms of car distributions. They have a lot to say about the driverless systems. I think they said they rolled it out to 100,000, the self-driving systems, and according to Elon, they're happy. The owners are happy with it. They updated on their energy front, and I'm trying to remember what else they said on the call. But all in all, I think it was a pretty upbeat call. I think the Bitcoin was sort of a distraction from, I think, what was really going on. And again, margins are temporarily under pressure. They hit their EPS, and then you just look at the chart of Tesla. I mean, you look at, it's as simple as this sometimes, guys. I had so many people with all the bad press Elon gets, and that picture of him being fat next to Bezos was pretty funny. But all the bad press, and he's sticking his nose in a lot of political fronts, and people don't like that. But come on, where's the Nasdaq? Again, I can't wait to get my bigger monitor. If you just overlay, this should work. Come on. Dude, what's going on? Okay. Oh, there we go. If you overlay Tesla over the Nasdaq, for example, okay, sometimes it's just as simple as this. I mean, look at the QQQ, the ETF that represents the Nasdaq. I mean, it was on pace, right on top of it through 2020 recovery up to 21, and then all of a sudden, Nasdaq makes a big low here in April, May, June, July. Tesla did not. Tesla did not. Tesla held in there really well, and that's why we maintained a pretty significantly overweight position. And I caught some grief from some clients and some of my friends. Why are you in Tesla? Blah, blah, blah. Look what Elon's doing. I'm like, the numbers continue to be strong, and it's outperforming the market. People are not selling their Tesla. And then all of a sudden, when you get a market rebound, this is the kind of move you get. You get Tesla up 10% in one day. We broke through resistance here. We had earnings last night. We broke through this resistance level. So now you look at this and say, okay, Tesla is through the June high. The Nasdaq, as measured by the yellow QQQ, is not. That's relative outperformance. So you have a solid earnings report, temporary margin pressures, factories coming online. Hopefully, they caught some grief because they're saying their free cash flow would be negative if they didn't liquidate their Bitcoin position. But okay, it's an asset; it's still on the balance sheet. I don't care if it's in cash or Bitcoin, whatever. And you're starting to get the results. So we have a pretty heavy weighting. I took some option positions home overnight for earnings in Tesla. So yeah, it's been good. So with that being said, oh my God, I wasn't showing the chart. I'm sorry, Marshall. How long? Oh God, sorry guys. I need to give you guys like a button to yell at me, or like a shock when I wasn't showing the chart. So yeah, so this is that's Nasdaq right there. Like just real quick, Nasdaq in orange, Tesla white. So Nasdaq makes the new low, Tesla in white barely makes a new low, and then Tesla just broke the June high, where the Nasdaq in yellow has not broken the June high. So we're seeing pretty good outperformance there in Tesla. So we held it, continued to be long, and I like it. Okay. I'm sure that's a lot longer than I wanted to go, but that's okay. I talk too much. I have a lot to say. So aside from that, I've been messing around with some Nasdaq call spreads. I just for the first time was able to execute system-wide, so like system trade, block trades for the wealth management business. So we've worked hard on that, and it's finally going to allow me to more actively trade across all clients. So I've been pretty active as the market picks up, and I think that's the big thing about being a trader, formerly and an investor, portfolio manager now. You don't always have to trade, but I did some Nasdaq call spreads. I did Tesla overnight, and my goal is as we're getting more and more comfortable in the systems at New Age, to offer another active portfolio. And I don't want to do it too quickly. We have our tactical dividend, we have our New Age Alpha, which is going to be rebalanced once a month, once every second month, and adjusted. But then I'd like to have a more active portfolio for those who would like exposure, on a week by week basis. So I don't want to rush into that. I want to move slowly into all the systems that we're moving into. It's a lot different than just being a research guy, flapping your gums and just writing research and just throw it out to you guys and say do whatever you want. But we have had clients ask, can we do a more active approach like options and long and short? And the answer is yes. We're just doing it very slowly. So we're getting closer to that, and I feel pretty good with the way things are going that we will be able to offer that for qualified investors. So okay, so that's good. So hey guys, thanks for hanging in there. Boy, that was a long show. Anyways, if you don't mind, throw the thumbs up out there. Maybe tweet it out or put it on your social media if you don't mind. That would be very appreciative. I've got to reinvigorate this YouTube channel. I've let it be dormant for too long. But so look, we are a full service wealth management, digital wealth management business. We are New Age Wealth Advisors. My partner Ryan is moving into his new house in Boston. You can find us at newagewealth.com. You have all sorts of information here. Right here, firm story, meet the team, services, the blog, how to contact us. You can read about our approach, sort of what we offer. So right there, and then if you would like to book an appointment to discuss the potential of working together, you can grab a time. You'll have to answer 5 questions to make sure you're somebody that is possibly a candidate to work together. And you and I will jump on the phone or Zoom for 30 minutes and we'll just chat. Okay? So that's that. Hopefully we see you guys soon. If not, check us out over at tradinganalysis.com. That's the team that takes care of you active traders who want to do it all yourselves. And I thank you very much for listening and watching. And it's fun doing these. I miss these. So I promise I'll do them more regularly. Signing off. Have a great rest of the week. Happy summer. And talk to you guys soon.